Okay, so today we're going to be going over the lessons I learned from Mike Maloney. Mike Maloney is the author of The Guide to Investing in Gold and Silver. So, lesson number one, the concept of wealth cycles was incredible. In a fiat money system, we believe that all assets go up in the long term. In particular, this logic applies to real estate and stocks. And kind of basically the idea is that, like, you buy stocks, you buy real estate, and you just hold it, and it'll go up. But you don't have to use fiat money as a denominator. You can use gold, silver, oil, corn, or any number of things. And now you can see that assets generally trade in a range. That basically you can tell when something is overvalued, undervalued, or fair valued, just based on the historical prices compared to each other. So for me, this concept was an absolute game changer. So here are the charts, what I've got for platinum. So I've compared platinum to the Dow Jones, and we see that the platinum price is extremely undervalued compared to the Dow Jones right now at basically record lows. Here we have platinum compared to real estate. It's on the low end of the trading range here. And then we go over to gold. It was at a previous all-time low. Now it's bounced back a bit, but still very much below the trading range. And then we move over to silver, and silver is just at the bottom of the trading range. So basically what I can do is I can use this whole concept of wealth cycles, because the idea of wealth cycles is basically it's like you buy things when they're undervalued and then you sell them when they're overvalued, and you can transfer over into the other asset, and basically the other asset's undervalued at this point in time, and you can ride it back down on the other side of the cycle, and you can basically ride from the bottom to the top, bottom to top, and you can kind of keep going back and cycling between this process and dramatically increase your wealth in the process. So lesson number two that Mike Maloney taught me was about monetary and economic history. I found that the lessons I learned from school just weren't all that particularly useful for monetary and economic history, but how he taught it was very practical and pragmatic. So kind of like what he taught is that all the fiat currencies that we've used in the past have gone to zero. But what I learned from school is it kind of made it seem like hyperinflations were kind of these rare occasions that happened with Weimar Germany or maybe with Argentina and stuff like that. And it was kind of like the assumption was that hyperinflations were the exception and not the rule. But kind of like having a more historical perspective really kind of helped me kind of shift my perspective. It's like this piece of paper, whether it's Canadian $100 bill or American $100 bill, 1,000 years from now, the only value it's going to have is kind of like as historical context. It's not actually going to be able to buy me $100 worth of food like 1,000 years from now. Like the value in the money is actually going to fall away. So that was just a very interesting reframe. Another thing that he kind of taught in his book was that there's the history of bubbles, manias, panics, and collapses. Like the tulip bubble, and I think it was like Norway or Belgium or something like that, where basically everybody was losing their mind about buying tulip bulbs, and it's like they would sell their house to buy tulip bulbs and stuff like that. And the South Sea bubble, whereas like the stock for the South Sea company went absolutely nuts. And then also on the flip side, panics and collapses. Um, it's kind of actually going through his book and seeing this history, it kind of made me realize it's like, oh, okay, like these things have happened again and again, like over, I mean, they might be 100 years spread apart, but it's like, it's very common that these things just happen on a repeated basis. And so now that I kind of have that context of what's happened in the past, it gives me an idea of like being able to see what could happen in the future. It's probably not going to be the exact same, but it gives me kind of a context and a framework for looking at the world. So lesson number three was you can't outsource the important things in your life. Mike tells a story of inheriting family money and then giving it to a fund manager who basically ended up losing 30 to 50% of it. They'd basically come in and say, hey, we did so well, we outperformed the market. The market was down 30% this year and we were only down 15%. And after a year or two of this, he's realized it's like, if we're just going to lose money, I'd rather lose it myself. So he kind of realized he had to figure this out for himself. He wasn't just going to be able to hire somebody to figure it out. So this led him to do a deep dive in history, economics, investing, and a whole lot of other things. I think that this is an extremely important lesson, that there are a number of areas of your life that you can't outsource. It's like you have to learn how to master them and stuff like that. So one of the things that Joe Polish talks about as a business owner is the two things you can't outsource is the checkbook and the marketing. So basically, like the checkbook is like you have to be in control of the finances. It's like you're the one that can make like the payments and stuff like that, so you don't have anybody stealing from you. And then you're the one that's in charge of the marketing. You got to make sure that the marketing's working, getting customers, and continue to build the business. And so I think in general, it's like our life has a number of these areas that we just can't outsource it to anything. Like the plumbing in your house, probably not that important. That you could probably get somebody to come in and figure it out. Like if you have like a broken toilet or something like that. But like your financial retirement and like your investing and stuff like that, it's like I'd probably try and figure that out for yourself because it's like if you trust somebody and they're wrong, it's like that could have a serious, delirious impact on your life. It may take a long time and a lot of mistakes, but I think that process is generally very worth it. So I kind of move over here to the concept of anti-lessons. So I think we can learn from people and maybe not exactly directly from the words that they say, but looking at their actions and seeing it's like, hey, maybe that wasn't the best way to go about things. So one thing I noticed with Mike Maloney is that over the past 10 years, he aged a lot. I stepped out of precious metals around 2014 to focus on starting my business. And I came back in when COVID hit and governments were printing money to have people stay at home. Seemed pretty ridiculous overall. So, but in that time period, I came back and restarted looking at his work, and it seemed like he had aged 20 or 30 years. Like in his previous presentations, he looked like this pretty young guy, like probably like mid 30s, maybe early 40s or something like that. Nice kind of like blonde hair and stuff like that. But when I came back, it's like his hair had turned like pitch white, and like it's just like there was these age lines and stuff like that, and it just looked like he was, I don't know, late 60s, 70s, maybe in 80s, and just yeah, just this very premature aging. And so my kind of assumption on what happened, I don't actually know what happened. A lot of things can happen, but my assumption is that he kind of took this position as a perma bull for gold and silver, and even built a business around that. So basically, the whole premise is that like gold's going up and it's going to go to a Dow Jones ratio of 1 to 1, and silver is going to go up to gold silver ratio of 16 to 1, and you're going to be able to buy real estate for like 500 or 1,000 ounces of silver. But it just didn't really turn out that way. Like basically after 2011, the precious metals went into like a pretty rough bull market or bear market where they retreated like silver back from $48 all the way down back to like $13, or maybe even got lower with the COVID, I'm not sure. But it's like it's emotionally exhausting if as a precious metals dealer and like kind of an influencer in the area, you're basically pounding the drum every day, every week, every month, basically saying it's like there's too much debt, this whole system's going to collapse, you need to be in gold and silver and stuff like that. And it just doesn't happen. You know what I mean? It's like the stock market goes up, the real estate market goes up, and gold and silver goes down. And I think it takes a very it's a very emotionally taxing process to go through. So the lesson I got from that is don't fight the world. It doesn't really care. Like, it doesn't care what you think or what should be logical and stuff like that. And one of the quotes I like is the market can stay irrational longer than you can stay solvent. So I think it's best to remain flexible, to remain open to the input from others and from the world itself. I think it's also good to diversify yourself. Don't let one thing completely dominate your life. And I kind of think that's one of the things that might have happened with Mike is that it kind of like his business and his teaching, all that kind of stuff, all focused around one thing and didn't necessarily give enough space and room for other different kind of options. I look at my life as like spinning plates, that I try to get one area of my life going pretty solid, and once it's done, I kind of move on to developing another area of life. It's not really a perfect system, but it helps create diversity in life and helps balance me out. It's kind of like I'll focus on maybe my health for a while and get that back into shape, and then maybe move over to like my business or move over to my relationships and stuff like that. Because I find it's a bit too much to try and take on all the different areas of life at once. But I also find that a lot of people, they find one area of life that they feel good about, that they have some success in and stuff like that, and then they like to double down on that again and again and again. So it's like the entrepreneur who's been successful in business and then just wants to keep starting more and more businesses while like the family life falls apart or their health falls apart and stuff like that. And I think in a lot of cases for them, it would be better to step back from the business and let it run for a while. Maybe not as optimally as it could be if you're there, but sometimes entrepreneurs are actually the problem in businesses. But that they go and spend some time focusing on their health or focusing on their relationships. And I think that that will kind of fix a lot of the bottlenecks in the life and make it so that they can be more successful in their business going forward. So my second anti-lesson was that just because something's happened in the past doesn't mean that it'll happen again. And don't stack extreme tail events on top of each other. So one of the things I noticed is kind of like what I was saying before, is that he basically looked at it as like the Dow gold ratio is going to revert to 1 to 1. It did that back in like 1930, kind of like when Nixon confiscated the gold and the Dow Jones had collapsed from like the Great Depression. It went to 1 to 1, and then 1980, when the gold price broke away from the like $35 peg, and we kind of went into a very inflationary environment in the 70s. It's like it also returned to 1 to 1. But these are very rare events that don't happen very often. It's basically like you're looking at like 2 years in the past 120 years of kind of like recorded time that those events have happened. And so betting that you're going to be there for the third time that might happen, it's like you could be waiting a very long time, and probably longer than you might be wanting to wait there. And then another ratio that he built on was like the 16 to 1 gold to silver ratio. And basically like 1 ounce of gold should buy you 16 ounces of silver. And it's just like if you look at the past 100 years, it's like that's an outlier. It's the same kind of thing. It's only been there once or twice. And then on top of that, he built in the premise that you should be able to buy a single family home in the US for 500 to 1,000 ounces of silver, somewhere in there. These ratios in historical terms are just so rare. Like they just happen once or twice every 100 years. And they might only happen for a few days or a few months. And I just don't think it's a very good idea to build your investing philosophy off of like these fat tail events repeating themselves, because you'll just be waiting a long time. So with like the real estate and silver kind of example. So here we have the chart. And basically kind of like this was, I believe, 1988. And then this is kind of 2011, 2012. And so I bought silver back in 2009 or something like that. So it was probably like around somewhere in here, this area. And then it dramatically outperformed. It went from like $20 up to $48 an ounce. But I was listening to him, and basically he was calling for it to spike all the way down to here, just kind of like they had done in the past. But it's like, these are very rare events, and there's no guarantees that they're going to happen. And you could argue that it was like the central banks interfering in markets and doing quantitative easing and any number of things that basically stopped this from happening. But I just don't think it's a very smart way to try and play the markets, is trying to wait for these like overshot bottoms. Like what I really think you should be doing is trying to just trade the range. And it's kind of like once it gets down to this range, it's like that's when you kind of swap out. So it's like for this chart, it's real estate silver. So like whenever you kind of get down to like this $6,000, $8,000 range, or basically one property buys you 6,000 ounces of silver or something like that, to me it makes sense that you'd want to transfer over into buy real estate, because these are cheap prices for real estate. So it would have been better if like in 2011, 2012, it's like you'd swapped out a silver and bought real estate, and then you see real estate dramatically outperform. And it's like right now it's fair value. So it's like you wouldn't really want to take a position on either one of these scales. Whereas if we go back up to platinum real estate, platinum is on the low end of this chart. So I expect that platinum to outperform real estate. But yeah, it's like you really want to be trading one standard deviation. So generally that's why I try to do my charts, is that this is one standard deviation below the median line, and then this is one standard deviation above the median line. And for me, that's just going to get most of the gains. It's like from this line to this line, I believe it's like 65% of the different possible outcomes is accounted for in that. And so you could definitely get a lot bigger gains in these fat tail events, but they're just so rare. And trying to bet the whole horse on them, or bet whatever, it's like it just doesn't seem like it's going to play out all that well. And like for me, it's like I really wish I would have sold my silver back in 2011 and moved into a cheaper asset class, because at that time gold and silver were basically the most overvalued assets, not compared to everything, but compared to a lot of different assets. They're definitely in the high range of things. So his predictions still may come true. We still may have like this kind of like blow off top in silver and stuff like that. But it's like that's not really what I'd want to try and base my investing philosophy off of going into the future. So anti-lesson 3, one of the things he stated is that he doesn't believe palladium, platinum, rhodium really have been used historically as money, and so you shouldn't consider them as investments for the upcoming monetary problems. And while it's true that they haven't been used for the past 3,000 years, I definitely get that. But it's basically just due to the fact that they have extremely high melting points, and it wasn't until we had like modern like technology to be able to heat them up hot enough that we could actually work with them. But when you think about it, they actually have all the same properties as gold and silver, and if not better, because they're actually much more rare than gold and silver. And then they also have industrial uses. So I definitely think that they should be included in the wealth cycle's value matrix, and that you don't just buy them to buy them, but you buy them at times when they're strategically undervalued, and you sell them when they're at like overvalued points in times. So the lesson for me was like, don't be beholden to your ideology. It's like you might have this intellectual framework about what you think is going to happen, but I really think that you should be able to look at the numbers and see if they make sense, and be able to let go of your ideology based on that. And also just be open to investments that you wouldn't normally think of if the numbers are telling you that they're extremely undervalued. So the summary is that I'm extremely grateful for all the lessons I've learned from Mike Maloney. I think that his book is required learning for anybody interested in gold and silver, and probably required reading for anybody interested in investing in general. But I think his philosophy is incomplete. I'm looking to continually develop my ideas and understanding of the world, and currently I believe that platinum is actually one of the most undervalued assets in the world. And ironically, the platinum group metals producers are the most profitable companies, and actually like the cheapest companies that I've found. And that's primarily due to the rhodium price that's gone absolutely bonanzas, and then the palladium price also going quite high and doing quite well for them. So the two companies I like for that are Impala Platinum and Sibanye Stillwater, and they're selling at about 2 times forward earnings. So yeah, thanks for watching.